Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of Shriram Properties Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Murali Malappan, Chairman and Managing Director. Thank you, and over to you, sir.
Thank you. Good morning, ladies and gentlemen. It gives me immense pleasure to be here with you all after another strong quarter sustaining the turnaround momentum. Since our listing in December 2021, as you might have seen, we have finished the quarter with 0.66 million square feet, 20% growth, while our revenues, EBITDA have more than doubled on year-to-year basis. Our profit stands at 10.5 crores against a full year profit of 18 crores in FY22. This is extremely encouraging for us and gives us the confidence to reach our FY23 target comfortably. On the cash flow front, as communicated earlier, FY23 is going to be a cash generating year for us, and I am extremely happy to say we made further progress, and therefore, with a certainty on the timing of this cash flow, our debt levels are likely to come down significantly in the next 12 to 18 months' time. It has been one of our key focus areas. I would like to reiterate that there is a very strong visibility of our earnings over the next 3 years, with 70% of our project revenues coming from volumes already sold till FY22, and 60% of our DM revenue to come from projects launched till FY22. The reliability on the earnings is only going to get better and better with our strong performance quarter on quarter, for which we are comfortably placed, having built a very strong project pipeline. During the quarter, we added 8 new projects with about 7 million square feet to the pipeline, and most importantly, we have completed 3 projects with 2.2 million square feet during the quarter, and on track to deliver 10 million square feet within FY23 and 25. So I thank all our shareholders for placing their trust in us, and I believe we are on the right path to create value for the stakeholders. With this, I would like to hand over to my colleague, Mr. Gopal, to briefly discuss the performance, and I'm here to answer any questions you might have thereafter the presentation.
Thank you. Thank you, Murali, and thanks everyone, and good morning to everyone. I hope all of you have seen the presentation which is uploaded on the website of the stock exchanges, and therefore going to refer the presentation and slide numbers before I speak. I hope I'm audible as well. If not, please let me know. Starting with slide 4 of the presentation on the website of the stock exchange. This is a slide very familiar to you, so I assume most of you have good familiarity to the overall industry landscape and industry performance during the quarter. But we would like to give our perspective on the sector as we saw during the quarter and as we see going forward. As highlighted in slide 4, the overall demand situation remains strong across most of the top 7 markets. Seasonality impact is always there. It will continue to be there. We saw some softening compared to Q4 level, which is very natural to this business. But on a year-on-year, we saw a very strong growth in demand, and that was very encouraging for us. Cost inflation-led price hikes as well as the rate hike had some impact on the customer decision making, but we believe that will be a very short-term impact because overall long-term dynamics for the sector and the residential real estate seem very positive, and therefore we see the demand momentum remaining strong and supporting overall growth. And this strong momentum will be backed by continuing positive economic outlook, rising income levels, as well as the pandemic-induced home ownership desire or the desire to own homes. All of this will feed into sustained demand, especially the segment that we operate, where mid-market and affordable housing, where the salaried class are the primary target customers. We see the overall undercurrent remaining positive. It had remained positive during the quarter, and we see it continuing even future. The inventory overhang in the sector actually came down remarkably, and it's about 22 months now across top 7 cities. Chennai and Kolkata actually registered a decline in the inventory levels or the inventory overhangs. Bangalore was almost stable, and therefore that's an encouraging sign. Positive demand outlook, reduced supply or reduced number of suppliers in the market in the wake of industry consolidation is driving this inventory reduction, and that augurs well for from a pricing perspective as well. Prices across 7 cities moved up by 2 to 3%. I'll talk about our own price improvement later. But ANARAG report clearly points out 2 to 3% quarter on quarter. That means the price level compared to March 22, June 22 prices were marginally higher. And in fact, if you look at it's a year-on-year basis, it's almost like 4 to 7% higher. Input cost pressures are moderated, which was a key topic or key concern some of you raised in our last earnings call. And it spiked during Q4 FY22, but I think it has moderated and in fact stabilized very nicely during the quarter. Some of the positive trends that we saw in the sector is continuing to remain intact, and that's a very encouraging development or encouraging canvas that's in front of us. Housing affordability remains largely favorable despite the recent rate hike concerns, which is likely to have a very small impact in the near term. But I think the overall affordability, as you can see from the slide on chart on the bottom, where this is actually extract from HDFC's site, the industry it's in a multi-decade low, and that's a very positive sign from an overall long-term demand perspective for the mid-market and affordable housing at least. Developers are offering some schemes and to fix the rates. That's most likely to accelerate customer decision making, like we saw in the corresponding period last year. And the income levels are rising. We've seen very strong demand for the talent in the underlying business sectors in the core markets like IT, healthcare, and so on and so forth. That's actually increasing not only income power or in purchasing power, it's also resulting in job security and purchasing power together. And that's a very positive ingredient for demand for residential for us. Consolidation trends is continuing. Large branded players are continuing to dominate the market, and the trend is likely to continue even as we go forward. All of this augurs very well for large branded players like Shriram, as well as other peers in the industry. Plotted development remains a positive sweet spot or a positive bias towards the plotted development continue. And so therefore many of our projects are skewed towards plotted development, which has a very high velocity as well as a very quick turnaround. Therefore, overall, it's very positive from a cash flow perspective for the business. We see a positive outlook for pricing, supported by strong demand as well as cost consideration. Industry consolidation, as I said earlier, is adding further fuel to the overall pricing environment. So overall, all the key ingredients are in place. We therefore think Q2, Q3, Q4 should continue to remain buoyant and help us achieve our full year expectations that we have indicated in the past. Moving to slide 6, these are our KPI numbers, the operating performance numbers. You may have seen the past from the earlier performance update released during the month of July. Just to recap, we had a very strong positive trends in the KPIs. Sales volumes were up 20% year on year. As I said, seasonality is there in the business, and therefore QOQ would be a misleading number. And therefore, I'm remaining focused on on YOY numbers. So compared to last year first quarter, our volumes were higher 20%. Our sales value was higher by 26% year on year. Collections were higher 34% at 324 crores or 3.2 billion rupees. Construction spend was higher by almost 50% at 137 crores for the quarter. So overall, the underlying momentum on the ground remains strong. We have about 4,000 laborers on the site, and nearly all our projects are on track within the RERA committed timelines. Another interesting fact was that average realizations have moved up. For us, it's about 8% higher year on year. That is 4,694 rupees per square feet in Q1 23 compared to 4,363 in Q1 22. And as you know, second half last year is when we had meaningful improvement in pricing. I'll talk about it in the next slide. Quarter on quarter, from March 22 levels, our prices have gone up by about 4% as well. Plotted development realizations are higher on a year-on-year basis. It's almost up 6% year-on-year. So underlying message is very simple. Key business parameters are remaining strong, and the quarter has proved to be an encouraging quarter for us. As you can see from slide 7, the Q1 performances put in the overall context of quarterly performances that we saw last year. Some of them are in the public domain in the past in the DRHP, RHP. Some of them are new data for you. But overall, I think the Q1 has been an encouraging start for us. Good start to the financial year, and we believe, given the positive industry environment, the momentum should continue and should help us achieve our overall target for FY23. Slide 8. We had one launch of a new phase in Chennai at our existing project called Park 63. Had a good start. It was launched on mid-June and early June, and the project has sold 11% of the new inventory has been sold already. As you would appreciate, this is the 30th June cutoff data, and therefore for about 20 days we have sold almost 56,000 square feet at this site. And as we speak now, we are well in excess of 17-18%. So it's an overall encouraging start to that launch. As you know, this has been a soft quarter for us due to seasonality. Only one launch. We have about 11 launches lined up for this year, for the remainder of the fiscal year, and this is supported by a very strong pipeline, and therefore we are confident of continuing launches that should actually bring momentum in terms of overall volume growth as the festivity, or as the normal season or the festival season picks up. That's a core season for us. Volumes typically tend to pick up during later part of Q2 and then gains momentum in Q3 and peaks in Q4. Slide 9 is a point that I was referring a few minutes ago. We had an encouraging price trend for the quarter. Compared to March levels, our prices are on an average have gone up by about 4%, depending on the project, anywhere between -1% or a flat prices to about 9%. So 1 to 9% is a fair description of price hike since March. As you know, from September only the prices have started moving up for us, for the southern market in general. And so compared to, so therefore, as you would see, we had already seen a 8% growth during H2 FY22. So on top of that, another 4% increase, and that's a fairly encouraging news for us. If you see on the chart on the bottom right, we have broken down the price because we have a project mix which can therefore lead to misleading. If you divide sales value by sales volume, you can get a very different distorted number. And therefore, we thought it would be appropriate to highlight how our plots, affordable and mid-markets have done. All of this does not mean only a price hike in general. It's a combination of a change in product mix during the quarter, what we sold, as well as the impact of price hike. And therefore, better clarity can be seen from the table on the left, where like-to-like comparison of the same project last quarter versus last year. So overall, it's an encouraging price front for us. Looking at the other dimension of our operating metrics, business development, slide 10 talks about it. We had a very encouraging note was that we moved 3 projects into completed with the receipt of OC and customer handover is beginning. We have moved them almost 2.2 million square feet from our original pipeline to completed project category. And we have also deferred or moved a few projects due to ongoing reviews and their current status. So we moved about 2.8 million square feet out of the pipeline. However, we have added about 8 projects aggregating to about 7 million. So we ended the year with about 53.3 million square feet, out of which 24 million square feet is ongoing, as you can see from the chart on the right. Out of the 24 million square feet ongoing, just to recap the numbers, 53.3 total pipeline, ongoing is 24, upcoming is 29. Out of the ongoing 24, more than 20 odd million square feet has been sold already, which means 85% of our ongoing projects have been sold, which clearly talks about the de-risked nature of our ongoing projects, as well as gives us the confidence that once we execute and hand over, they will result in income recognition, and that's a very positive situation, a positive news for us. And so we started this second quarter with about 3 odd million square feet of opening inventory for sustenance, which means the continuing launches will feed volumes for us. We have no overhang or problems of inventory issues here. As you have noticed from last earnings call also, we have zero inventory in completed projects. That situation remains true even as we speak now. So overall project pipeline breakup, if you look at the chart, the tables, the bullet points below give you clarity about some of the projects which have been moved to completed. But if you look at the breakup, it's a fairly well distributed. Our own projects are about 27%. JVs and JDAs together account for almost 40% of the pipeline, and DMs continue to account for nearly 1/3 of the pipeline. So the overall mix remains unchanged. A small change here and there in the first decimal, but otherwise overall mix broadly remains same. 1/3 is DM, about 28% is our own projects, which is mostly Bengal and a few projects ongoing in Bangalore and Chennai, and the rest is all coming from JVs and JDAs. Moving to financial metrics, slides 11 and 12. Overall, the big picture, overall positive earnings. Turnaround momentum continued even in Q1. So this is the third quarter of positive earnings after we got listed, and meeting our own expectations as well as what we guided the investors in the past. To build further on the Q4 trends, we are improving operating leverage as well as increasing share of DM income in the overall revenue pie is adding strength to us. Revenue recognition for more ongoing projects during the remainder of 23, both in SPL as well as our joint ventures, should help us deliver strong revenues and earnings in the coming quarters as well. Business momentum remains strong. Business lead indicators are reinforcing our confidence on delivering the stronger earnings and profitability in FY23 as indicated in the past. We made reasonable progress in terms of reducing our debt level, which today remains at 0.3:1, and also the cost of debt. I'll explain that as we go through in another slide. Slide 13 and 14 summarizes the financial performance. Just walking through a few bullet points on the overall financials. Q1 FY23, as I said, has been a fairly encouraging quarter for us. On a YOY basis, revenue and EBITDA more than doubled. More important for us, earnings turnaround momentum continued. We ended the quarter with about 10.5 crores or 105 million rupees of net profit, compared to 180 million or 18 crores that we reported for audited financial year for FY22. Revenue growth is driven mostly by increased handover and registration momentum in two of our projects that we discussed in the last earnings call, which is Grand One in Kolkata and last leg of registrations in Panorama Hills in Vizag, where we should complete and exit this city by end of this calendar year. Shriram Summit in Bangalore received OC, and therefore handover commenced, registration commenced. That gave us income recognition capability in this project during the month of May. Unfortunately, one of our projects got delayed in terms of receiving OC by a couple of months, and that is Shriram Southern Crest in Bangalore, where we expected some support, initial support from registration of Shriram Southern Crest in Q1. That got moved to Q2 FY23. The fire NOC has been received, and therefore we think we should get the OC from the regulatory authority, from the authorities during this month, and that should give us registration capability in the month of September and get some kick up in Q2. And these 3-4 projects together accounted for over 60% of revenues recognized during the quarter. Grand One, Panorama, Summit, and smaller projects like one in Coimbatore and a plotted development in Bangalore called Shriram Earth Whitefield. All of them, 5 of them together accounted for 75% of revenues during the quarter. Our revenue from operation, 122 crores, also includes DM fee. DM fee accounted for 18 crores out of this 122 crore number. So about 62% growth in DM fee. More than that, encouraging fact for us would be that the DM fee is now coming from 9 residential DM projects. That's more encouraging for us because now it's broad-based. DM is no longer just making only a volume impact, it is now beginning to show revenue impact as well. And that's an encouraging development for us, and it's a continuing trend. Also, we completed one of our first DM effort. This is a commercial property in Chennai, which we used to own. We sold it to Xander Funds, and we are now we have now completed the project, and the entire DM has been the DM settlement agreement has been signed during the quarter or post the quarter. And during the quarter, because we completed the project, we were able to recognize the last tranche of DM fee which was left in that contract at around 4 crores as well. So all of this together helped improve the DM income on a quarter-to-quarter, on a year-on-year basis. Expenses were relatively slow growth, and employee costs, obviously the cost of revenue is directly linked to the overall income recognition that we did. And if you look at the overall other expenses, employee 16%, but is still lower than Q4 levels. As you know, this is a fixed cost in nature. Therefore, sequential growth is important, and it's down 9% from Q4 levels. All our costs were higher year on year as well, 3.2 crores higher. And despite all of this, because the revenue cost growth was slower, we had a healthy EBITDA margin at 24.5%. As you would recall, we consistently maintained that we are looking forward to stabilizing EBITDA in the mid-20s. I think we are ballpark within that same range. And we think for the full year, we should be able to maintain a mid-20 EBITDA for FY23 and EBITDA at a healthy level of 35.5 crores for the quarter. Interest costs were lower by 13% year on year. And more importantly, I think the interest cost needs to be broken by actual interest expense. There are some non-cash charge associated with the government of Bengal, West Bengal royalty that we provide in our balance sheet on a discounted basis, so we unwind that impact. Third one is, of course, the refinancing costs, and both these are either one-off or non-cash charge. So therefore, I'm focusing on interest expense, which was 21% lower year on year at 18.6 crores. Even on a trailing basis, it's lower than Q4 interest cost of 21.5. That's when we started our refinancing work. I'll talk about the refinancing separately, but overall, it is encouraging to see a declining interest, which is a combination of falling interest costs as well as reduced gross debt. The combination of those two are helping us. We believe the trend is going to continue. You would notice that the share of profit from JVs have turned positive as well. As you recall, we have investment. We have 4 projects executed in a JV format, 3 in Bangalore and 1 in Chennai. Chennai project is in a joint venture with Mitsubishi Corporation of Japan. That's their first maiden real estate direct investment in a project level in India. This project called Park 63 is, before I go to that project, in the JV context, as we have explained in the past, we do a equity pickup, and therefore, till the projects come for income recognition, we will recognize our share of costs, which is the marketing expense, overheads, employee costs. All of this is at the JV level are picked up as our share of costs, and therefore we usually have a small negative number till the projects come for revenue recognition. For the last year Q1, we had 8.5 crores as our share of loss. For the full year, we had our share of loss of 22.6 crores. Against that, while the our share of costs are continuing in 3 joint ventures, the Chennai joint venture, which is Park 63, got completed and OC received, and therefore income recognition and customer handover started. As a result of income recognition in Park 63 phase 1, we were able to recognize income to our share of income of about 9.6 crores, and that's a positive sign for us. And whereas this income would have been higher, but for the losses that we picked up in 3 of our joint ventures, where the projects have not reached the income recognition level as yet, which is the 107 Southeast in Bangalore, as well as Whitefield Youth Town, or we call it UA or WYT, have not reached the income recognition level, and they are still some time away. So Park 63 was a big contributor to the income from joint venture. Reflecting all this, as I said earlier, we closed the quarter with about 10.5 crores net earnings. Slide 15 talks about the cash flows. We had a positive net cash flows from operations, even after making new project investments, new JD advances and others, which is aggregating to about 36 crores. We still had positive cash from operations. So if I do it on a comparable basis, we had more than 400 million or 40 crores of positive cash from operations, which is encouraging as well. And we had significant prepayment during this quarter as well. And so overall, reflecting the loan repayments and the interest expense, we had a cash flow from financing was negative 59 crores. So we used our cash and cash equivalent to that extent. We ended the quarter with a cash and cash equivalent of about 87 crores, which is a fairly strong liquidity position for us. And we have an undrawn limit from banks, and therefore liquidity remains strong. Cash flow from operations have been positive, and the net free cash flow was negative, but there is sufficient opening cash balance, and therefore we were able to draw from there and end the quarter with about 87 crores of cash balance. In sum, overall enterprise cash flows remain strong, and we think it will gain further momentum as we go through some of the large value cash flows that we were expecting during this financial year. From signing out, now that we have signed the Xander, the closure of Xander project will bring us cash flows to the tune of about 100 odd crores. We also have the other large cash flow items that we discussed in the last earnings call, arising from monetization of our land bank in Chennai, Logos transaction, which is progressing well in Kolkata. These are positive cash additions to us during the fiscal year. So overall, cash position remains strong, and outlook for cash flows remains strong as well. Looking at slide 16, ongoing efforts to reduce debt and cost of debt has made meaningful progress for us. Just to clarify upfront, we have no land bank related cash flow debt in our books. As you know, we don't do land banking except for Bengal, which has been paid from equity investment by private equity players several years ago. There are no land bank in the company, point number 1. Point number 2, there are therefore no debt associated with land bank. So all of our net debt or a gross debt of 450 crores and net debt of 360 crores, All of this relates to working capital in our ongoing projects. And if I take only a non-plotted development project, we have about 10, 11 ongoing projects across 3 cities. Those 10, 11 projects consume together 364 crores of construction or 450 crores of gross debt as a construction finance. So that's basically we're talking about 40, 50 crores of debt across different projects at the project level. So that's not material concerning debt for us, but our efforts to reduce the debt is continuing. In the last 6 months, we've repaid about 200 crores from IPO proceeds. We have refinanced 2.265 crore worth of debt in SPL books, SPL consolidated books. Apart from that, the JV level where we do equity pickup and therefore it's not in CF consolidated financial. JVs have some debt. Almost the entire debt at JV has got refinanced. 380 crore worth of debt has been refinanced. This is a 100% JV debt. Our share would be half of it. And so the transactions have made good progress, and some of them are nearing documentation right now. So the full impact of all this refinancing will start showing up in the further reduction in debt interest costs in the subsequent quarters. We have always maintained that our high cost was primarily because we are focusing on NBFC as our biggest source of finance. The slide on the chart on the right side in slide 16 tells you that we have moved away from excessive focus on NBFC to banks. Banks now account for 39% of our loan gross debt compared to 3% share that it had in the past. So overall meaningful progress. Cost of debt, as you can see from the top right chart, averaging around 12.5%. We think we should be able to end the year with a cost of debt of about 12% or lower as we progress remainder of our refinancing program. Incremental cost of debt is close to 10% or lower. We have moved to bank finance, and we've raised some debt at the joint venture levels at 9.5 to 10.5% from banks like IndusInd Bank and State Bank of India. During the quarter, we consummated those transactions. So overall meaningful progress is what I wanted to actually place on record. Slide 17, some of the significant awards. There are a few more, but I think it's been a good quarter in terms of external audience appreciating our progress and efforts. Slide 19, I just want to emphasize the fact that as Murli pointed out at the in his opening remarks, the visibility for our earnings forward, be it 23 or the next 3-year cumulative, 23, 24, 25, remains encouraging for us. Slide 19 talks about the immediate term. There are 4 for 62% of full year revenues, and these 4 projects have a very strong visibility in terms of completion and their earnings recognition threshold. Sudan Crest, as I said earlier, got delayed by a couple of few weeks, and we have now reached a fire NOC, and we are confident of closing OC in August. Grand One, only sale deeds are pending, getting registered as we speak, and Summit OC has been received, registrations have commenced. Park 1A OC received, Park 1B OC is expected. So overall, most of these projects are the OC stage, and therefore the revenue recognition should be within reasonable risk as we see. And this share of this revenue moves up to 83% of our planned revenue will come from these 4 projects, as well as if I add Gateway Mall monetization plan that we had. As you know, our full year revenue expectations when we gave the growth guidance did not include the Bengal FSI, and therefore I'm continuing to keep that outside, and that will add further impact, but more on a cash flow basis. Therefore, the projected revenues, we have good comfort level in terms of achieving them in FY23 as a full year. DM revenue, the same thing. Whatever we expected for the full year, not just the Q1, Q2, Q3, Q4, we see a good visibility because 11 ongoing projects, 33% of the volumes will come from DM for the full year. Ongoing projects will account for about 65% plus of DM income in current year. And as I said earlier, new projects to add about 33% of DM income. but 33% of our pipeline is also DM already. So overall, earnings visibility seems reasonably strong. Not just a year, I would probably take a broader call given the nature of our business. If you look at a 3-year cumulative, I'm just highlighting to you the key ingredients to our revenue recognition here, instead of getting into absolute rupee guidance. Overall, if you look at we have sold about 10-12 million square feet in the last 42 months. And the last 3 years alone, about 10 odd million square feet has been sold. I'm not even bringing FY19 into the picture. And if I add that, it's about 12 odd million square feet has been sold. And we are actually, as we speak, all of these projects are ongoing, and therefore they are on track against committed RERA timelines. And therefore, we have a very high level of comfort and confidence on handing over close to 10,000 units or 10 million square feet over the next 3 years. So that is fiscal 23, 24, 25. And that actually gives us a good confidence on revenue recognition capability, not only in FY23, but also 24 and 25, because this 10,000 square feet would mean on an average around 3 to 3.5 million square feet annualized. And that basically means that 1,500 crores of revenue recognition, even assuming some rule of about 5,000 rupees per square feet. So therefore, there's a very strong path to revenues, and given the confidence that we have expressed on staying around EBITDA margin, we therefore see a meaningful revenue, EBITDA, and net earnings outlook. And therefore, looking to slide 21, as I said, some of these are already have spoken, and therefore we see a very strong earnings outlook for us. And more importantly, on a 3-year basis, we are very confident of our achieving our strategic objectives, which means bottom part of our slide, achieving at least a 20% plus kind of growth in volumes, corresponding growth in revenues or higher revenues as we move up the price curve, and sustaining profitability in the mid-20s, therefore delivering positive net earnings. More importantly, stabilizing our ROCE in the mid-teens. As you know, we have already reached 11-12% ROCE in FY22 from about 3-4% 3-4 years ago, and that's a meaningful progress for us. And we believe we should be able to comfortably stabilize ROCE in the mid-teens over the next 12 to 18 months. From a long-term strategic perspective, unlocking potential from Kolkata and staying focused on DM while also continuing to work on JV JDA should be our thrust area, and that's exactly what we have summarized in slide 22. And while doing all of this, we believe we should be reaching our desired target of 4.5 million square feet in FY23 compared to 3.8 million square feet that we achieved last year, and rising up gradually to about 5.5 to 7 million square feet by FY25. And that we remain confident of these numbers as the business has shaped up over the last 1.5 quarters by now. And in achieving all of this, I just want to spend last 2 minutes on both the new growth engine of DM as well as Kolkata. Just 1 minute each. DM remains a growth engine for us, and DM volumes have grown considerably over the years, especially ever since we started emphasizing on DM a couple of 3 years ago. Today, it accounts for about 28-30% of sales volume. We believe for the full year also, DM will be close to 1/3 of our sales volume in FY23, million plus to 1.5 million square foot max. And the DM revenues will continue to account for 20% of our revenues. The slide, of course, talks about all the DM projects that we are launched, and in addition, we have, of course, 9 million square foot of DM to be launched at different stages of during this year and early next year. So overall, DM pipeline is strong and will continue to be a profitable growth option for us. Our fees are currently ranging around 20% inclusive of costs. If I strip out the core DM, still remains in the 11-12% of for SPL. As we have discussed in the past, it's a win-win solution for both us and the landowner partners, and therefore there is enough traction on it. We can discuss that in detail as part of the Q&A. Murli and Ramesh, our ED operations, both of them will join me in explaining our perspective on DM if we need to discuss more. Similarly, on Kolkata, as we have explained in the past, and we can continue to discuss that as part of the Q&A, we made a good progress. As we have reiterated, as we have said, and I reiterate, 10 million square feet is what we are intended to develop ourselves. Remaining will be an FSI in the form of FSI sale, either as an FSI or an FSI equivalent land. And in our own development, we made considerable progress. You see in slide 24 some of the handover snapshots continuing to gain momentum. There are images on the right are actual site images as we speak. I would encourage strongly some of you to visit the site to see how nicely it has come up from a barren land a few years ago when we got the approval in 2016-17 to a nice completed first part of the project, which is Grand 1. Grand 2, Sunshine, is making progress. From a sales side, nearly 95% of phase 1, which is 8 lakh square feet, is sold. 26% of second phase, which is another 8 lakh square feet, is also making good progress. So overall, we have sold almost 1 million square feet out of 2.3 million square feet for the project. So 50% of the project is sold. The third phase is yet to be launched. We will make good progress. Once we make a meaningful progress on phase 2, we will open up the inventory of the third phase, which is our strategy which we have followed for most large projects, open in phases so that we sell meaningfully in the opened volumes and don't over-distribute among towers, and then we'll end up spending money on construction of all towers, which we don't want to do. And therefore, we open in phases. So it's making good progress. FSI sale, MOU with logos is making meaningful progress. As we said, we target to complete this transaction during H2-23. It involves a sale of a large land parcel it's a sale by Shriram, 2 logos, which is a Australia-based warehousing major, now integral part of ESR group in Asia. So it's a very large player in warehousing development, and the transaction is making meaningful progress. To sum up, it's a well-governed, professionally managed, real estate listed player. Very strong brand, trusted brand among customers as well as the landowner partners and other stakeholders. Proven track record, strong growth outlook. We have now delivered consistently meaningful performance for, I think, the third consecutive quarter and post-listing. And I think we are on path to deliver meaningful results in coming quarters as well. And scalable, demonstrated ramp-up capabilities and scalable business model. And in a consolidating industry environment, a strong player being a beneficiary of this changing landscape. Low debt equity, 0.3:1, as you would have seen in the previous charts, with a very strong partnership and track record in the capital markets, financial markets, therefore have a ready access to capital for growth, both from project level partnerships as well as the lenders. So we are focused on executing our strategy that I have discussed, and we believe we are well positioned to navigate in the industry environment and deliver value for our shareholders. With this, I'll stop. There are some additional slides that some of you desire to have as a data when we met last or when we spoke last earnings call. So we have those data put in. With this, I'll stop and I'll hand it over back to SGA, our IR advisor, to open up for Q&A and back to Murli. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Chaitanya Shah from Silverlight Capital. Please go ahead. Mr. Chaitanya Shah, please go ahead with the question. Your line is unmuted.
Hi, am I audible?
Yes, sir, you are.
Yeah, hello, good afternoon, sir. So my question is regarding the slide number 28, where you've given the detailed cash flows, net operating cash flows that you expect. My first question is, what is the, if I add all these cash flows, then the total comes to around 1,000 crores. Now I just wanted to understand what is the timeline that you are giving for this.
Yeah, that's a good question. I should have clarified. So this is only ongoing project. This is not enterprise life cycle cash flows. So this is only life cycle cash flows of the ongoing project, 1,000 crores. Appreciate that. And this would be, these projects, ongoing projects will be completed in about 24-30 months. Maybe 24 will be a right number. So then comes all the upcoming projects will add further to the SPL cash flows. If I can just give you a ballpark number, not sure that's price sensitive or otherwise, since the public call. The overall NPV of our life cycle, our project cash flows alone. I'm not bringing DM fee into it. I'm not bringing land values and cash flows from land banks, monetization, all that I'm not bringing. Only the 53 million square feet pipeline, if I execute all of them, including ongoing projects, the NPV of that cash flow is in excess of 2,000 crores. NPV. That's the limited point I want to make. So I think people should not jump to wrong conclusion, therefore I'm clarifying. So this cash flow, 1,000 crore undiscounted, is only related to ongoing projects for the next 18-24 months. The entire company's pipeline projects, when I execute and complete, the NPV of them will be in excess of 2,000 crores and discounted at something like a 13.5%, 14% level.
Okay, all right. Just wanted one more clarification. Now, if I add the total saleable area, it comes to around 24 or 25 million square feet. Now, you said on the call that you're delivering 10 million square feet. So I just wanted to understand that are you going to be delivering close to 25 million square feet, or are you going to be delivering 10 million square feet? Because this cash flow is for 25 million square feet, right?
Yeah, the cash flows will be for all of us, including DM, JV, JDA, and own development. And the current schedule of completion over the next 12 to 24 months, 10 million square feet will be delivered. The rest will come in that FY26, I guess.
So then the 1,000 crores would be something that, would come over a period of 5 to 6 years, if I'm, if I look.
These are ongoing projects, not, it will be between 3.5, 4 years max.
So basically we are saying we are going to deliver close to 24 million square feet in 3.5 years, right? Because this total comes to around 24 million square feet on the slide.
Yeah, true. No, he's asking 10 million. 10 million versus 25. So, yeah. Yeah, correct. Of course, the cash flow, my colleague is pointing out cash flows do not include DM cash flows because we get only revenue, which is not the point, which is an additional clarification. Because these cash flows are only for the developed projects, right? Our own projects, not the DM cash flows.
So I mean, I just wanted to confirm on the total amount of square feet on page number 28 is 24 million, and you mentioned 10 million, so there is a difference, right? So I just want to confirm what are we planning to deliver in the next 3 to 4 years?
So if you look at FY23 to 25, 10-11 million square foot will be delivered from all the models.
Okay.
Some part of the ongoing delivery would have commenced. In FY22 also, we would have delivered some, right? We delivered about 1.2 million square feet in FY22 also. The rest spillover volumes would be delivered in FY26. When we talk about,
Okay, so this basically ballpark what I can take is 4.5 years is what I can expect for the cash flows that are given on this slide to be realized.
Yeah.
Okay, and this doesn't include.
You are focused on only ongoing. I've given you the answer already. On a DCF basis only I've given. Right? Forget about 4 years or 7 years. All the projects put together, my DCF itself I've given you.
Okay, all right. And also in terms of the cash flow that the company is going to get from the Logos deal and the Xandr deal, do you expect to be net debt free in 1.5 years? Is that a reasonable assumption to make?
Yeah, I think gross debt will always be there, right? When an ongoing projects are there, you need construction funding, so there will always be gross debt. Net debt negative, yes. I think that is as Murali has consistently maintained over the last couple of quarters. We intend to be net debt negative in about 18 to 24 months.
Okay. Okay. All right. That's it from my side. Thank you.
Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Priyanka Gandhi from Ace Capital. Please go ahead.
Hello, sir. I just have a couple of questions. Firstly, for the DM model, what is the risk if the landowner is not able to fund the project on timely basis?
Okay.
Shall I ask all the questions in one go, or
No, go on.
for you to answer?
Yeah.
The second question is, our cost of debt is still higher at 12.5. Do you think we can bring it down in this year? And my last question being, what would be the total capex you expect, and what can be the expected collections in FY23?
Okay. I will make a shot at the first question, that is regarding DM. So your question is whether there is any fund non-availability by the landowner side, what will happen to DM? As you rightly said, at the time of valuation of the project itself, we will know what would be the likely fund requirement. For that, we want to make the financial closure at the very start of the project itself. So normally, in the several projects we've done so far, we never come across situations where such instances occur that we have to fund from our side. In most of the cases, we are discouraging the people to get the cash out. It's primarily on account of the working capital which is required for the project, which you always funded through banks and other NBFCs. So the situation is not arisen in the past, and we'll be able to foresee that much well in advance at the time of evaluation of the project, so that we will not be left with any kind of such situation in future.
With regard to cost of debt, yes, our intent is to keep working towards go down. I don't know what your benchmarks are, but fundamentally we have no lease portfolio in our books that can get you a single-digit interest rates, which is some of the listed players will have the commercial portfolio giving LRDs at 7% and 8%. As a resi player, you will not reach that point. I don't think we can guide you on that. But yes, the 12% is or thereabouts is the target for this year. And we believe we will still be in double-digit interest rate even if we go down further. So the only way we can bring down the interest burden would be to keep bringing down your gross debt levels, be more capital efficient in terms of the construction funding needs at project level. And that's fundamentally what we are working towards. From a capex and collection perspective, collection for this year would be about 1,600 crores, 1,600 crores would be the full year collections, and our capex would be in the 800 crore range. When you say capex, it's basically a construction cost. We don't have a capital goods. We don't do a capex at company. As you can see from our P&L, depreciation is like less than 1 crore. So we don't have a big capital goods in our company. We don't have a capital goods in our company because we don't do construction of our own. Therefore, our own capex will be minimal. Fundamentally, we will spend money on construction, and that project construction activities, we should spend about 800 crores as a construction spend during the year.
All right, sir. Thank you. That was very helpful. That's all from my end.
Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Devendra Pandey from DP Financial Advisors. Please go ahead.
Thank you. Good afternoon. I have 3 questions. So my first question is on the competition side. So we are witnessing lots of property developers entering the southern market, especially in Bangalore in recent times. So do we foresee any increasing competition risks going ahead?
Some more questions, or is the only question?
I have 2 more questions, sir.
Yeah, you can give both other 2 also.
Okay. So my second question is, how much is the expected IRR company works on before starting the project, and how does it differ across the development models? That's my second question. And third question is, how many projects do we expect to deliver in the next 2 years, and what would be the expected revenue recognition for those 2 years projects?
Okay. I'll address the first question, competition. I don't see a bigger threat on the competition because the entry barrier is becoming tougher and tougher, particularly post-FRIRA and the consolidation today. So it's a game for large players today. Small players in niche markets can do still well, but competing with the large players will be difficult. We welcome good competition. If there is some more large corporate coming into the field, it is going to be doing not good to the industry. So we welcome, and in fact we encourage. I have been personally talking to various large corporates to get into real estate and also expand into all the markets, so which is going to help further consolidation of the industry and also boost the customer confidence. So it is only going to help. Particularly on the mid-market and the affordable housing segment, as we keep emphasizing time and again, the demand which is there for a long period of time, I don't see the demand coming down in the next 8 to 10 years time, particularly on mid-market and affordable housing. Luxury segment, there could be oversupply, there could be a demand mismatch, supply-demand mismatch, but not on the mid-market and affordable. So competition is going to help people like us in a very, very positive way. So on the other 2 questions, expected IRR before underwriting any project, we look at roughly about 22% IRR is what we look at across all the projects, whether it is a JDA or outright purchase or a DM. DM, of course, it's an infinite IRR for us, but the project for the landowner should have that kind of an IRR. So that's the beginning point with which we look at any project. There is a question. On the delivery and revenue, as I said, the current thought process is that we will deliver about 10 million square feet in 3 years. I think it's about less than 2 million square feet this year, and then goes up to 3.5 million, and then ends with about 4.some million square feet in FY25. So 3 years, 10 million square feet. So that should on an average 5,000 rupees a square feet is a ballpark number that one can assume. Will deliver revenue recognition capability to that extent.
Okay. That's all from my side. Thank you.
Thank you. The next question is from the line of Faisal Hawa from SG Hawa and Company. Please go ahead.
Question. So, sir, how do you feel that Calcutta sales will pan out, particularly in the large tract of land that we have, and what are we specifically doing on the warehousing? And how do you feel that our 2025 sales will be? Can we reach around 3,000 crores sales completed by 2025?
Okay, I'll address Calcutta. Calcutta, as you know, that project we launched in 2017 during Dussehra. In the last about 4 years' time, we have sold about 3.2 million square feet. Suddenly, of late, particularly after the global investors meet, we were in West Bengal recently, about I think 2-3 months ago. We are approached by a lot of local developers to take up their projects either on joint development or development management. Then we took a serious review on net of it for some of the senior developers in Calcutta. Then we realized about 3.2 million square feet in about 4 years, which gives an average of about 800,000 square feet per year, which puts us in the top 1 or top 2 developers in the market. So we see a big potential, and our micro market location is very well established today, and also delivery started now. The first set of apartments are being handed over now, and the construction is going full swing today. So we expect Calcutta market will be a big game changer for us, and we expect to generate good amount of cash flow from Calcutta. And also government has been playing a very, very supportive role in making sure that project progress well. On the warehousing, as Gopal briefed earlier, this Logos, very large multinational company on warehousing specialist. So we have part of our 314 acres, we have set aside some portion of land wherein they will be setting up warehousing. So that is going to create a big demand further for us, not only the warehousing development. Recently, Chief Minister of West Bengal visited our neighboring land in this car manufacturing unit and made some announcement bringing some more industries into the neighborhood area, which is not an adjacent land to us. Hindustan Motors, as you know, there are 700 acres land out of 314 we bought. Remaining land parcel, government of West Bengal has been aggressively looking at bringing some manufacturing units, and they brought somebody now, and she was there for inaugurating the facility. So we expect that is also to create further demand in the micro market. So Calcutta, we are bullish on the current position.
On the 3,000 crore mark, I think there are 2 ways to look at it. One is about sales value. Second is income recognition. I think we are currently in the sales value wise, we are around 2,000 crore currently. 4.5 million square feet should somewhere take us, assuming a fair mix of plotted and apartments. I think we should be exceeding that threshold this year. 3,000 crores, I think will take at least another 18 months. FY24-25, I think will surely be in excess of 3,000 crore sales value. From a revenue recognition perspective, I think currently, if you are going to deliver about 4 million square feet in FY25, I would think we would be in the 2,000 crore income revenue recognition mode. That translates into whatever is EBITDA and the PAT that I'm sure you can do it yourself in terms of mid-20s EBITDA margin is sustainable. So therefore, it translates into whatever the indicative numbers that you can do back of the envelope. But fundamentally, I think sales value will reach faster. Obviously, will reach faster. It will take a couple of more years to reach that 3,000 crores of revenue recognition, which I'm sure very few listed players do even today.
Most of the time, we are targeting an IRR of 25% or so. What the ROC of the company still remains, very low, and is it because of the historical projects being still complete and some overruns in the project?
Yeah, because the revenue recognition is still slow, right? If you look at our sales, you always have a 3-year lag between what we sell today and what we are income recognizing, right? So it will take a couple of more years to reach. But having said that, 14-15% ROC is in our view would put us in the first quartile of returns in the sector. we will be there
very difficult to achieve.
It's fairly, the certainty is very high in reaching that number. And IRR 25% is one aspect of it, right? I don't know whether listed players will have, most listed players will have 25% ROC or ROE in their books anytime soon. I have not seen any, but I don't think that's a number that is. Most players work with this threshold, right? Because then it's a portfolio of projects, right? Each project has their own dynamics, and then you strip out all the organizational cost from it. And so 25% ROC, I don't think we will reach there. That is in the meaningful future. I don't want to misguide anyone. I don't think we'll reach 25% ROC at least in the foreseeable future. When we reach 15% ROC, I think there's a very high comfort and confidence in reaching that in about 12 to 18 months.
To clarify further, even the peer industries, even though they have a lot of projects in the past so many years, with the 25-27% IRR, still the ROC is less than 10-15%. You can take top 2-3 builders. So there will be some kind of mismatch between those and the IRR in any case.
Involvement, and how do they see this amongst the various businesses that they have? And is there any attempt? How is the promoter's involvement in the business? And they have various businesses. So where do they see this business as joining into the whole gamut of things? And the promoter holding also remains quite low. So is there any attempt to increase that?
It is started by this company, started by me with the Shriram Group partnership. So promoter's commitment continues to be the same between me and the Shriram Group, and I'm committed to this business for the next 20-25 years. So I wish, I could stay much longer. So Shriram Group also, very firmly committed to this business of real estate. As you know that at group level, there has been a consolidation. We are consolidating into financial services and real estate, and not many businesses, only few businesses we are consolidating. There is a very strong commitment from the promoter for this business and for its growth.
Does that answers your question, Mr. Fez? As there is no response, we'll move to the next question, which is from the line of Pranay from J&J Holdings. Please go ahead.
Hi, sir. Good afternoon. Thank you for this opportunity. Sir, you mentioned that 2.8 million square feet have moved from the pipeline to hold. If you can just throw some light, the reason for the same, and will they get revived in some near future? Or that would be.
Yeah, I'll let it clarify. So yes, they have moved from. We have temporarily moved it out of the pipeline because given the complexities involved and certain delays in achieving milestones that we thought we would achieve faster, we thought we didn't want to disturb our pipeline with projects that are not moving smooth. So we have removed it for. You can call it temporarily, parked it out. It will come back. It will come back once some of the land-related issues or any other. Each project has their own intricacies. Once they get resolved, they'll come back. But for now, we didn't want to artificially have a high number which is non-performing in part of our whole pipeline. That's the only reason it has been removed. It's not that it has been shelved. These projects are still very much in the works, but that need some resistance. Each of the projects have their own issues to be resolved. Once they get resolved, either the lower level issues or project level issues, approval related, they will come back.
So these are all our own projects, or some of them are in JV?
These are all none of them are our own projects. These are all JDAs and DMs.
And moreover, to prioritize, because we don't want to spend our bandwidth on the project which is not able to come back that soon. So that you can now equally see that there are additions of close to 7.8 million square feet of new projects added also there. So that the churn will be happening. Depends upon the priority and how soon it can be launched position, we will change between these buckets.
And what would be our investment over there as our share
Nothing.
so far?
It's a DM project. We don't have to.
There is no capital loss.
So all of them are the DM projects.
Some are DM projects, some are GDA projects.
JDA would mean a small token advance would have been given because only when you consummate the project, then non-refundable deposits or other deposits go from us.
Only on approval and normally we pay that.
So therefore, the capital exposure will not be meaningful here. Because they have to reach that stage to be able to get that capital, right?
Okay, so not meaningful exposure currently.
Yeah, no meaningful financial exposure.
Okay, and my second question is this net debt of 360 crores would be our basically own debt, consolidated debt.
Yeah.
Okay.
On top of that, we have our share of JV exposure. That would be our Shriram share would be about another 200 crores now. Those interest and those debt will be serviced by the joint venture. I'm just giving you for sake of completeness.
Thank you so much.
Thank you. Before we take the next question, reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead. Mr. Tushar, please go ahead with your question. Your line is unmuted. As there is no response, we'll move to the next question, which is from the line of Chaitanya Shah from Silverlight Capital. Please go ahead.
Hi, thanks for giving me the opportunity again. My question is regarding the free cash flow that you mentioned in the slide of 3 billion. I wanted to understand, does this include debt repayment as well, or is this excluding of the debt repayment?
Which 3 billion you are talking about?
The free cash flow, the free cash flow that you mentioned of 3 billion, slide number 19.
Understood. Slide number 15, right?
Slide number 19.
Okay. Yeah, so this is a ballpark estimate over 3 years based on our cash flow model, what we expect for the next 3 years, what should be the overall capital unlock. And between 300 and 450, depending on some of the projects coming through, not coming through. That's net of all debt repayment, the scheduled repayment, everything. Because as you know, we have project level debt, right? Some projects may be borrowing, some projects may be repaying, depending on the project status. So this is true free cash flow, not the cash flow from operations. It's a free cash flow after meeting all obligations, including any project-related investment that we make at JD advances or otherwise.
Okay, so this also includes any new project investment that you make?
Excluding, after making all that, whatever we know we have added. So this 3 billion or 300 crores will be available as a growth capital if you want to aggressively chase new projects.
Okay, over and above the 53 million that we already have in the pipeline, right?
Yeah.
Okay, and also does this include the Bengal land and the Xander deal?
Yes, does not include the. No, it's not included. Bengal is not included.
Xander is included.
Xander is included.
Xander is included. Bengal is not included.
Okay. Okay, all right. That's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
Hello. Hello, can you hear me?
Yeah.
Yeah. Okay. Thank you for the opportunity. I had 3 questions. One is, you said your NPV of your own development projects is around 2,000 crores. So what is the discount rate that you use to calculate this NPV?
13.5.
13.5.
Yeah.
Okay. Okay. And this includes JDA JV projects or only your own 100% own projects?
All projects included except DM, where we get only DM fee.
Okay. Second was, what is your method of revenue recognition? Sorry for the question because I've not followed this company previously. Is it project based or is it percentage completion?
No, it is project based on completion. Now the accounting standard allows you only to do revenue recognition on completion and handover of the project to customer. That is why you see most of the sector players report lumpy revenues from time to time, and they are not evenly distributed. So no percentage completion is allowed. This is on completion and handover of the unit to customers, you can recognize income. That's what we do.
My third question was, what are your annual overheads other than the direct construction related costs, your admin, sales, marketing, which will be treated as period costs because they won't get apportioned to the project as the project progresses?
Absolutely. As you rightly caught it, sales marketing, actual marketing and promotional expenses are project related, and all the construction costs are project related, so they are capitalized and expensed whenever the project comes for revenue recognition. Until such time, they sit as a capital work in progress, against which we have customer loans, customer advances stay in the liability side of the balance sheet. So the period costs are very simple. There are 2 things.
Marketing costs also you capitalize and carry forward?
Yeah. Now, except for the brokerage, other things, it's on top of the sales, which is straight line. It's a different kind of thing. It's equivalent to the capitalization.
So all the channel partner commissions, brokerages are capitalized as part of the project cost. The advertisement and other costs would be a period cost. So there are the period costs are basically therefore advertising, promotion related, employee costs, and our rent, return, taxes, right? All the corporate related costs, which is the premise rent, lease rental costs, rent, all the rates, taxes, all that is calculated. Combination of all these 3 things.
Other than advertisement, which will be related to your launches, what are the fixed costs per annum?
Yeah, so my fixed cost would be somewhere around 65-70 crores per annum.
Okay. My last question, sir, is on slide 23, I think, or 22. You've given that you will scale up your sales volume from 3.8 million to 7 million square feet in next 3 years. I mean, that's very impressive. How confident are you of doing this, and what would drive this?
We are pretty confident on this due to 2 things. We already have good pipeline of projects. As you know that we have over 50 million square feet of projects across various cities, and we have the pipeline is very much visible, and most of the projects are fully secured now. It's only timing we need to do it properly. For example, this year we are planning to launch about 12 projects. One project launched in Q1, and about 5 projects are lined up for Q2, and about 6 projects lined up for Q3. So last year I think we had about 8 projects. So there is a good lineup of projects which are in pipeline, and we are also approached by lots of other developers and also financial institutions to take over their projects on either a joint development or DM. So we are pretty confident that we should be able to achieve this goal.
I mean, that's very, very impressive because usually in real estate, people are not able to scale up. Even in your case, last 3 years, the volumes have been flat relatively from FY19. And this includes, I assume, development management also, right? 7 million includes everything.
Yes.
Okay. Thank you for answering my questions, and thank you for the opportunity.
Thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Yeah. Thank you. Thank you everyone for joining us at this earnings call. And in case you have any further queries, please feel free to contact us or SGA anytime. Happy to clarify any additional queries you have. Sincerely thank everyone for their time taken to join us, and thank SGA team for hosting this call. Over to you, SGA, Rahul and Shriram.
Thank you. On behalf of Shriram Properties, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.